Welcome to Mortgage Math with April Blackwell. I'm April Blackwell with Blackwell Mortgage, a locally owned and operated Raleigh-based mortgage company. I'm here to help you understand mortgage math, my favorite topic, a little bit better. Today's topic is debt to income ratio. It is also known as DTI, debt to income, and the term is ratio, which is a percentage of your income that goes towards debts. So how we're going to calculate your debt to income ratio will be based on the current debts that you have plus the mortgage debt that you want to have divided by your gross monthly income. Now, for today's purposes, I'm going to calculate the debt to income ratio based on a simple math that I can do without a calculator of $10,000. This is gross monthly income. I'm going to use this figure to solve for the maximum mortgage payment and loan amount that somebody making this income with my proposed debt scenario can qualify for. So let's just say at $10,000 per month, perhaps it's a two income household. They're each getting $5,000 and that's equaling $10,000 per month. And we have a couple car payments. We have borrower one has a car payment of $500 and borrower number two also has a car payment of $500. And guess what? They also have student loans. And let's just say, for simplicity, they each have a student loan payment of $500. This totals, any of my math whizzes out there? How much?
$1,000.
$1,000 in student loans, $1,000 in car payments is a total of $2,000 in current monthly debt. Now, the aim is 45%. Most automated underwriting engines and most loan programs will find that 45% of your gross monthly income is acceptable. This is not for everyone, nor always, but for today's simple math, we're gonna go with it. So $10,000 per month times 45% as a decimal, 0.45, we get $4,500 per month. This is the total debt that this household can support. But we know we have $2,000 over here in existing monthly payments. That leaves us $2,500 for a mortgage payment. And again, I'm going to keep things really simple. I happen to know, because I do mortgages, that this payment is being referred to as the PITIA payment, which is principal, interest, taxes, insurance, and association dues. So let's just say we need to subtract $500 for our TIA. Our TIA is $500. By the way, don't talk about TIA to your friends because they are not going to know what you're talking about. They're going to think you're talking about somebody's auntie. So it's not that kind of TIA. It is just April Blackwell, TIA. It looks cute. So 2,500 minus 500 is $2,000. All right. I do not have a finance calculator in my hand. However, at today's current rates, we're talking about $5 per thousand, okay? So how many thousands do I? So if I take this $2,000 and I divide it by 5, I'm going to get 400. 400 times 1,000 is a loan amount of $400,000. $400,000 is the max loan that our family here, making $10,000 a month with $2,000 in existing debt, can be qualified for. This does not mean this is how much they should borrow. They should not borrow more than a total PITIA of $2,500. Yet it's important to ask, what is a good payment for you? You may say, oh my God, I could never pay $2,500 because I have other expenses. I've got daycare, I like to take vacations, I support my family. There's other things that go into that. So don't ever automatically go along with the maximum you qualify for, but use it as a cross-reference for what you can really afford to pay. Now, loan amount is not sales price. This is the max loan someone could borrow given this scenario. Their sales price, the max that they can afford, is going to be determined by how much cash and resources they have to go into that. Some loan programs may qualify you at 100% loan to value. And if you missed our previous topic on loan to value, please go back and watch it, because the loan to value is based on the lesser between appraisal price and your purchase price, okay? And most programs, let's say you should prepare for a roughly 5% down payment on the lesser between appraised value and purchase price. This means that your loan can go up to that max loan to value, but then you have to pay that premium differential on top of it. So let's just say this person has an extra $50,000 and it meets the minimum loan to value requirements. That will get us a sales price of $500,000. Please feel free to review this and apply this template to your situation. Again, the template in the model is gross income times 0.45, gross monthly income, monthly, times 0.45 equals total allowable part of your income to cover all recurring monthly debts. That does not include cell phone insurance and those kinds of things. But what is you're legally obligated to repay on your credit report, child support, alimony payments, all go into that. That 45% less these debts equals your total monthly payment. Subtract out roughly 25% of this payment for your taxes, insurance, and association dues. That will leave you with the P&I portion of the payment. Divide that by 5 to get your dollars, the dollar base amount, times 1,000 to get your max loan amount. Add to that as much money as you have in this market to get your maximum sales price. I hope that you found this mortgage math useful and helpful. We hope that you have a wonderful day.